Folks, welcome to Building Credit. We're gonna get started in we're gonna get started in about a minute. So just a brief overview of Cooperative Federal and who we are. So we are a community development financial institution. We are a credit union, and we focus on service to people who are of modest means, people who are working folks, people who, I like to call us the credit union of the people. I use the word people a lot. But really, I mean, you know, we're here as a, we're here as a resource and to support our members, and hopefully, you know, if folks are interested, they can join us as well. This is our mission. Our mission is to rebuild the local economy in ways that foster justice, serve people and communities that are poorly served by mainstream banks, and responsibly manage our members' assets. So, you know, I guess the last thing I'll say about this is that, you know, like, we find that a lot of financial institutions are not set up to support people wherever they're starting from, and so that's what we try to be. So these are some credentials. We're a community development credit union. We're a not-for-profit. We're owned by our members. We were founded in Syracuse by community organizers focusing on ending participation in apartheid South Africa, and have been committed to social justice ever since. And we are also a HUD housing counseling agency. So we provide one-on-one housing counseling. I'm the housing counselor on staff, as well as financial counseling, and are connected to the FEC, which I'm going to talk about in a little bit. And obviously we're, you know, a credit union, so we're overseen by the NCUA and all of that. We focus strongly on home ownership because we believe that home ownership is a way for, by investing in homeowners in communities who have not had access to capital, we can, you know, help those folks build assets for themselves as well as build the community, because homeowners tend to stay longer, and they tend to be better able to support community growth. Okay, so this is, let me get that out of the way. Yeah, so I'm the housing counselor on staff, and I've been doing this for 15 years. You wouldn't know it by my presentation skills this evening, but I'm a little bit worn out. It's been a long week, and it's only Monday. But you know, we have all of these services in-house, as well as the connection to the Financial Empowerment Center, which I think is, to me, the most exciting thing that we've done recently. Syracuse Financial Empowerment Center is a city program. So it's run by the city of Syracuse, but managed by home headquarters. And it's free one-on-one financial counseling for whoever needs it. We focus on city residents, and but no one would be turned away, so anybody can participate. And you know, the idea is that, you know, just as this marketing material says, you know, you deserve to not worry about your finances. You deserve support and assistance. And so that's what we do. We make assistance available around financial issues for everybody, regardless of their ability to pay. This is Kaz. Kaz is my co-presenter tonight. Actually, she's going to do the bulk of the presenting around on the topic of this evening, which is credit. As you can see, she's bilingual in English and Spanish. She's been on staff at home headquarters for 2 years, been counseling since July 2019.
Yep, thank you, Tom. I am one of the Financial Empowerment Center counselors, and anyone can set up a session. It doesn't matter if you are tight on money or you make $150,000 a year. There's no income limit to this program. So please, if you think this would be a useful tool for you on your homeownership journey, I encourage you to make an appointment. So the 4 areas that we focus on at the Financial Empowerment Center are helping people increase their savings, reduce their debt, increase their credit score, and access banking products. So opening your first checking or savings account and otherwise. And before we get started, I would like to define the word financial empowerment center for you all. So financial empowerment comes when you feel in control of your financial life and confident in your ability to make good choices in whatever direction it takes. All right, and 4 questions I like to ask people during their first session, just to kind of get the gears turning, are: what is my relationship with money? What are my goals? What changes will I need to make in order to reach those goals? And am I ready? So am I ready to make those changes? And the answer is yes. We try to do what we can to remove any obstacles in the way of getting you to where you want to be. So here we are talking about credit. So what is credit? The ability for a consumer to obtain goods or services before payment based on the trust that payment will be made in the future. So in other words, it's the ability of institutions to lend you money before you have it. So the promise that you will repay it in the future. And your handling of credit is what makes up your credit history. So that's a record of your responsible repayment of debts. So if you paid on time or if you missed a few payments, that's all a part of your credit history. And that's important because it's going to show up on your credit report when a lender, when you apply for credit, a lender will pull your credit report. So the credit report is a record of your credit history from a number of different sources. So banks, credit card companies, collection agencies, or governments that will all show up on the report. The 4 main parts of a credit report. So when you pull your credit report online, or if a lender pulls your report, they will see your identifying information. So your name, social security number, current or previous addresses, your birth date, and your employer. And it's a good idea, if you can pull your own credit report, to review this information for any inaccuracies, because if there's a name that isn't yours on there or some information that doesn't belong to you, then there's a chance that someone else's information might show up on your report, and that might impact your ability to access the credit that you are seeking. All right, and the second section of your credit report is your public record information. So in the past, that would include things like liens, which is if a creditor or some other source has sued you for a debt that you owe and the creditor won, that would show up. And also foreclosures, if you had stopped paying on your mortgage or fell behind on property taxes, that would have shown up. The foreclosure would show up on your credit report. Nowadays, the only public record information that will show up is any bankruptcy. So Chapter 7 or Chapter 13 bankruptcy would show up on your credit report. And the bulk of your report is going to be your credit history. So that's all information about your loans, your credit cards, any possible defaults, negative information, or derogatory accounts. And most information, there are some what's the word? I don't know. Most of the information on your report will stay on there for 7 years, with some exceptions. 7 is the magic number, and my pop-ups are preventing me from viewing the whole screen. All right, and then the 4th part of your credit report is any inquiries on your report. So if you applied for a credit card or a loan, or maybe a rental application, anytime you request that an entity pull your report for those purposes, that will show up on your report for 2 years. So that's some of the basic information there. And now I'm not able to go to the next slide. Okay, there we go. All right, so why is that important? Why is that report that shows the last 7 years of your credit history so important? The information on your credit report, your credit history, will allow you to buy a car, rent an apartment, buy a house, start or keep a business, get or keep your job, or also access certain types of bank accounts. Your credit, for example, a business bank account, you might need to have positive credit history in order to have access to that. So it's important to access those things through credit, and the better your credit score is, the better the terms. So you might qualify for a car, but if your credit score is low, there's a chance that more than half of your payment will just be going toward interest. So if you can follow the steps that I'm about to show you on a future slide, hopefully you'll be able to raise the credit score and decrease any future interest payments you might have to make. So first I will do some myth busting here. All right, so myth number one, a bad credit score is forever. And that is absolutely not true. I work with people all the time who come in, their credit is absolutely destroyed. Maybe they don't have one positive credit account in their name, right? It's all delinquencies. You can rebuild your credit from whatever state it's in, even if you've had a bankruptcy. My supervisor and the person who trained me is a housing counselor, just like Tom is, and she's worked with people who have declared bankruptcies and gotten everything straightened out in a few years, was able to rebuild their credit enough to qualify for a house. So whatever state you're in now, there is mobility. we can change that situation. All right, and the second myth is that checking your credit report will hurt your score. So where that comes from is what I was talking about on the slide before, where if a credit card company or a lender pulls your credit, that will show up on your credit report as an inquiry. And if you're doing that pretty frequently, that can cause your score to decrease. However, as consumers, you have the right to view what's on your credit file. So you can check your own credit report for free online, and that will have no impact on your score whatsoever. It's your information. You have access to that. Myth number three, education level can impact your credit score. So that's also not true. Things like your education level or other identifying information like your race, your gender, how much income you have, that will not impact your score. Your score is based on, did you follow through with the promise you made with the lender? So if you took out a loan, your promise is to make this, X payment every single month. And if you're able to keep whatever promise you made, then that's where your positive credit history will be seen. So it doesn't matter, again, if you're high income, low income, it's whether you can make your payments on time. All right, and 4, you can't get credit unless you have a lot of money. So that's related. Your credit limit on a credit card or your mortgage amount that you qualify for will depend on what your income is, because you have to demonstrate that you'll be able to pay back what you borrow. But your credit score is based on how you manage whatever credit you have. So whether it's a big loan or a tiny loan, it doesn't matter. As long as you're handling the credit and making those on-time payments, you can have good credit. And the 5th, all credit and debt is the same. So I think what's meant by this one is that just to go over the fact that there are different types of debts. So the main two are revolving and installment debt. So revolving debt would be like your credit cards or your line of credit, where you can borrow a bit, you pay it back. It's a little flexible in that way. Whereas an installment debt would be something like a car loan or a personal loan, where you take out one amount at the beginning of it, and then through time, you're paying that debt back. So you don't add on to that loan. So there's that. All right, and so the credit score, a lot of people that I meet with are most interested in their credit score, those 3 numbers, because that's what's going to, in your case, get you qualified for the house. One of the big steps is to get that credit score increased. So let's go through those factors here. So the biggest factor on your credit score is going to be payment history. So the most powerful thing you can do for your credit is make sure everything is on time, no delinquencies, and just as it's the most positive contributor to your credit score, it can also do the most damage. So one missed payment or one collection can really drop the score. And it takes a while to build the score back up, because you really want to demonstrate that's an outlier, or that's how I used to be, but look at me now. I'm really managing my open accounts. So that's the most important factor there. And the second most important factor is your credit utilization on your credit cards. So that would be, what is the balance on your credit cards or your line of credit compared to your limit? So this is where I kind of mentioned this before, where you don't need a $20,000 credit card. It doesn't matter whether it's $20,000 or $200. Can you manage the credit that's given to you? So you want to keep that balance at or below 30% utilization. So the lower you keep the balance, the better. And the reason for that is you want to show creditors that you have access to that credit, but it's not a need. It's not dire. You're not overextended. You have access to it, but it's not a necessity that you use it every month. All right, so actually before I go on to that, these are really the main two things. So we're going to talk about a lot of different things tonight. If your focus is your credit score, those are the main two things. If you can pay on time, avoid any delinquencies, and keep your credit card balances low, then your credit score is going to continue to rise through time. And then there are some smaller slices on the pie chart. Jenna called it FICO pie last week. I kind of liked that. So your length of history is also important, because if you are new to credit, you have a credit card that's open for 1 year and make the on-time payments, that's going to look positive. The way to raise your score at that point is to show that you can continue to do it. So 10 years of positive history, of course, is going to look better than 1 to 2 years of positive payment history. And that takes into account both how long your open accounts have been open, but also if you have any closed accounts in the last 7 to 10 years, that will also factor in. All right, and then types of credit is the fourth FICO factor, and that's talking to having a diversity of types of credit. So maintaining both installment loan balances and also revolving. You want to show credit card, you can handle your credit cards and you can handle your installment loans. And Tom, feel free to jump in if you think there's something else super crucial to include in any of this. And the fifth factor there is new credit. So inquiries, like I mentioned before, if you're applying for credit cards, applying for loans all the time, that's going to go on your credit report for 2 years. It's going to stay on there. So that also can have a negative impact on the credit, because it shows you're constantly looking for new debt. So if you're on the homeownership track, most of the time, it depends on your situation, it's a good idea to halt any new credit applications. And that's a good reason to meet with an FEC counselor, because of course, if you have no credit history, we can get you connected with some positive ways to build credit without going super into debt or paying too much toward interest. All right, so I threw a lot at you. I expect there will be a lot of questions in the chat box below. So, all right, you might be wondering, how do I view my credit report? I have the right. How do I do it? So you can see at the top, annualcreditreport.com is the free official way to view all 3 of your credit reports. So there's Experian, TransUnion, and Equifax. And it's good to look at all 3 just because there are some companies that might only report to 1 or 2 of them. So if you're only basing your knowledge on 1 of them, you might be missing some crucial information. So you can access that. It's called annualcreditreport.com because typically you can only pull your credit once per year. Due to the pandemic, though, they have changed that, so you can actually access your reports every week through April of 2022. Fingers crossed that things will be a little more normal by then. I think that's what their thinking is. So there's that. So that's going to show you the report, but not the score. So what some people will do to view the score is they'll download the Credit Karma app or make a Credit Karma account online. One key thing to know about Credit Karma is their credit scoring model is actually different than a lot of lenders. So I have a ton of clients who come in and they think that their credit score is one thing, and then I pull through the Financial Empowerment Center software, and they'll see a very different score. And that's not because Credit Karma is wrong, and that's not because the FEC has the wrong information. It's just a different scoring model, kind of like a different grading rubric based on the same report, your credit reports, but two different ways to grade it, so to speak. So Credit Karma is still a useful tool, even though the numbers might be off, because any changes to your credit will show up on there. So it's a good way, a very user-friendly way to access the information on your TransUnion and Equifax reports. And then the one other important thing to know about Credit Karma is it's free, but that means that they are going to advertise to you various financial products. So they might tell you, open this credit card or get this secured loan. It'll help you with your credit. That might be the case. But what I tell people is just ignore it. That's how they make their money, is they have to advertise these things. Because in many cases, it will actually drop your score. If you already have some open accounts and you're opening new accounts, you've got a new inquiry, you've shortened your average account age by opening that brand new account. So I just say ignore it, and you can open some new credit if it's strategic, in order to, for example, if you don't have a credit card at all, maybe you could look into that. Anyway, I think that's everything for Credit Karma. And all right, so that's an overview of credit. That's some basic information just to get our feet wet a little bit. Everyone's situation is a little bit different. So if you would like some free help going through your credit report, you can feel free to book an appointment with one of the financial counselors. You can do that by calling the number on the screen, extension 5, emailing fec@homehq.org, or if you want to visit the website, syracusefec.org, you can put in an appointment request there. And I think that's everything for today. So
Okay.
very there.
So we're going to take this and we're going to put it in the context of qualifying for a mortgage, right? So having a good credit score is a big part of getting qualified to buy a home. But you should know that there isn't necessarily a minimum credit score for qualifying for mortgages. I mean, not a hard and fast one anyway. They change. But under current guidelines, the kind of bare minimum credit score to get an FHA, which is the Federal Housing Administration, their mortgage product, is a 580. But do recognize that with a 580 credit score, first of all, your rate's going to be affected by that. Just like Kaz was saying, your rate, you'll pay more in interest if your score is lower. And in addition, FHA will throw up additional sort of hurdles for you to overcome to get a mortgage with a score as low as 580. So for example, in this case, usually FHA is going to increase the down payment requirement for someone who's walking into the application with a 580. So instead of, an FHA loan, generally speaking, can have a down payment as low as 3%, 3.5%, I can't remember, 3 or 3.5%. So a relatively low payment. I mean, a relatively low down payment. But with a 580 credit score, you're going to be looking at more like a 10% down payment. So ideally, and we'll get into this a little bit later, but it's best to start thinking about buying a home, a year and a half to at least 6 months before you actually want to apply, so that you have time to look at your report and identify the strategic things you need to add to boost the score and put those into place, and then allow them to have the time they need to get onto the report and show history on the report. So it's kind of like, it's not a switch. Credit reports are not a switch. You can't turn them on or turn them off. It's more like a seed, right? Where you like plant something and then you wait some time for it to grow. And you don't see the results until some time after. And I would say 6 months is kind of a bare minimum to get some history going. Conventional fixed rate loans, so those are the mortgages you'd generally like to shoot for, right? To be able to qualify for. Not that there's anything wrong with FHA. FHA can be a great product, especially if you are struggling with a lower score or you have, some other difficulties. But conventional fixed rate mortgages tend to have the lowest rates. They also are a little more favorable when it comes to mortgage insurance, which is, a little bit complex. But bottom line, you kind of want to shoot for a conventional approval, and that's bare minimum of 640, and then for in-house for our mortgages, right? So Cooperative Federal has mortgages that we do conventional mortgages, but we also do in-house mortgages, which means that we hold those loans in portfolio. So when we make the loan to you, you will also pay your payments to us, and the loan will be our loan. And so we can make those decisions in-house. We don't have a minimum credit score for those loans. It's up to credit committee, which is a group of volunteers from the community who are members who look at applications, take into consideration things beyond credit score, right? So they're gonna, usually if a loan's gonna go to credit committee, I tell clients, write a letter explaining your situation, why, how we understand that, yes, everyone, that the credit scoring model is built on this idea of responsible payments lead to good scores. But we also understand that just because you didn't make your payments doesn't mean you're not responsible, right? Something may have happened in your life that is a totally reasonable reason to have stopped making your mortgage payment. I mean, stop making your other payments on something, or something happened that, you needed to deal with that resulted in this negative credit score, having a lower credit score, but in reality has nothing to do with, had you been able to, you would have continued to make those payments, right? And so we look at those things, and we're going to take those into consideration. So the credit committee will, so there's no minimum credit score, right? We're never going to say no to somebody based solely on the credit score. We're going to look at the whole situation. And so that's the Cooperative Federal mortgage product. But that mortgage product, because and this is something that's a little useful to know. You'll notice that it says 5-1 ARM. That stands for five fixed for the first 5 years and then adjusts every year thereafter. So it can go up or down based on a market rate, which used to be the LIBOR. But anyway, we don't need to get into that. But the bottom line is the rate can change. A lot of times folks are like, well, why do you do that, right? Why do you have this adjustable rate mortgage? I'd rather have a fixed rate, and I totally get that, right? The reason why Cooperative Federal's in-house product is like that is because we are a small financial institution. And what happens is, mortgages are, by the way, the biggest piece of our lending, because mortgages tend to be bigger than every other type of loan, right? A mortgage. So think about an institution like Cooperative Federal, where we're less than 50 million in assets. So you get 10 $100,000 mortgages, and we have way more than 10 $100,000 mortgages. That's the bulk of the money we're loaning out is mortgages. If we loan out money now at 3%, and 5 years from now, the interest rates that we pay on our savings accounts are at 5%. Now we are bringing in 3% on the money that's sitting out there in the world, lent out to people, but paying 5% on interest rates to people in our savings accounts. So now we lose money every month when we pay out that interest. And so the adjustable rate mortgages, because they are a large part of our portfolio, and because we're holding them in-house and we're not selling them, we need the ability to raise rates on those if rates go up, because we can't continue to pay out interest on savings at lower rates than we're getting back in on our mortgages, which is the biggest part of our portfolio. So it's this catch-22 situation that we find ourselves, which larger lenders and the secondary market don't have to deal with. They don't deal with depositors, right? They don't have to pay savings rates because they don't do that. That's not what they do. So it's a tough spot. And if anybody wants to get into the finer details of what they call asset liability management, I'm happy to have that discussion. And I'd love to, especially now.
Uh-oh, looks like Tom's cutting out for a second. He should be back in about a minute. He said this happens from time to time.
I just realized I might be stuck there.
Yeah, you were stuck.
Yeah, okay.
But you didn't get the joke in, so.
I did get the joke in? Okay, good.
Yes.
Great. So, we've always been taught as counselors that, lenders want to see 5 trade lines. So they want to see 5 accounts. And that I feel like is less true now. In speaking to other lenders who are looking at people for mortgages, they're not saying to me, oh no, we're not going to look at that person. That person's file is not, their credit score, the term they use is thin. Their credit score is thin, that we don't think that's really a 700 credit score because they only have 2 trade lines or 3 trade lines. I would say shoot for 5. I would say shoot for 5. If you have 2 or 3, if you can add a couple of additional credit cards, not to have a balance on them, not to use them, but to have them. If you use them once in a while to keep them active, but keep them paid off. Credit cards are great that way if you can, be diligent in monitoring your credit report, making sure there's no unauthorized transactions, all of that stuff. It's nice because you can build a really good score with credit cards with $0 on them and pay nothing in interest and nothing in fees, as long as you're paying attention and making sure there's no annual fees on those cards. You're then gonna, you're building credit and it's not costing you any money. So you can add a couple of trade lines, but again, you need to add those trade lines 6 months to a year in the past, right? And obviously none of us have time machines. So you need to be able to, look out a year from now and say, okay, a year from now, I'm looking at buying a home. Let me add those 2 other credit cards now, keep them paid off for the next year. And that's probably the easiest way to add a trade line. If you sit down with a counselor and you have no installment loans, so you have none of the loan types that Kazmira was mentioning which have a regular monthly payment, then you can add what's called a credit builder loan. We'll talk a little bit more about that. But again, that depends on what you already have. If you're walking in the door with 5 student loans, those are all installment loans. Not really a reason to add an additional credit builder loan there, unless you're going to use that credit builder loan for something else, like a forced savings product, right? That might make sense. But generally speaking, in that scenario, if I see somebody walk in the door with 5 student loans, and no credit cards, we're going to add probably 1, maybe 2 credit cards to their credit report, and we're going to let it ride, and that's it. So. No loans in default, obviously, right? So if your student loans are in default, that's going to be the first thing we're going to deal with. Having a bad credit score walking into a mortgage is going to mean your rate's higher, and your rate being higher is going to mean your monthly payments higher. So the higher you can get your score before you apply, then the better rate you're going to be offered, and therefore the lower your monthly payment, and that's great. And then once you own the home, of course, you want to continue to keep your credit good, because what if you need to borrow money to fix something, or you have some issue with the home? And we encourage you obviously to save and have that money available, but we can't always plan for things. I remember the day that I found out that my sewage pipe had collapsed underground, and it was going to be about $5,000 to dig up my sidewalk and replace and put in a patch so that I could have a sewer or have outflow from my house. That was awesome. That was great. And that was a time when I needed to borrow some money to fix that problem. So you want to keep your credit in good shape when you're a homeowner, definitely. Okay, so a couple of strategies. So secured credit cards, right? That's where you put money up. So generally speaking, if your credit score is 620 or better, you should be able to get an unsecured credit card. The key things to look out for: watch out for high annual fees. Find a card that has no annual fee, that has and that will approve you, even if it's only a small limit. And again, going back to what Kaz said, it doesn't matter how much what your limit is. It matters the ratio of what you use to what your limit is. So if you have a $300 limit, as long as you keep it at a zero balance or under $100, under 30%, then that's going to be good for your score. So it's not, you don't have to have a lot of capacity to borrow to build a good score. If you can't get a secured card, you can't get an unsecured card and you need to get a secured card, the FEC and Cooperative Federal, in partnership with Home Headquarters, obviously, we have a credit card product that you can use that you don't have to come up with all the cash yourself. So we can do a $300 limit card. Home Headquarters received and provides funding from a grant to secure 250 of the card, and then you can get you put in an additional 50, and then you add a card. So that's a good way to do it. You can also just do this with any lender. It doesn't matter, with your own money, right? So if you have, 150, $200 or whatever, you can walk into any lender and say, look, I want to put this down as collateral. You hold on to this, give me a credit card, and I'm going to keep it paid off, and it's going to build my score. And then there's also products that go by many different names, but they're all credit builder loans. These are installment loans. The way they work is essentially the loan is made to you now. You make monthly payments, but the funds are not given to you. So you don't actually receive the funds. The funds are put into an account and held. And then you make payments against that loan. The lender reports you to the bureau saying this payment was made on time, this payment was made on time, this payment was made on time. Your score goes up because you've made payments on time. And you then, at the end of the loan term, the money that you've paid in over time in the form of that loan that was put on hold and locked up, that's released to you minus what you paid in interest, right? So, at Cooperative Federal, the interest rates we charge on these are like 3.95% because we need to cover the cost of operating the program. But do watch out for self-lender programs. So there are many of them out there. Just the key is, it can be a fine product that doesn't have to be bad, but look at the rate that they're charging. If they're going to charge you, think about it this way, right? If your lender is gonna, if the lender's not going to actually put any money at risk, right? If they're loaning you $1,000, but they're not actually giving it to you, there's no money at risk. There's no way they can lose that money. They're holding on to it. So if they're going to charge you 15% as if it's a credit card, on $1,000 that you don't even touch, that's just a way to harvest money from you. You know what I mean? The general rule is that you get paid interest for putting your money at risk. If your money's not at risk, why should you be paid high interest rates? That doesn't make any sense. So just read the fine print. I was reading the fine print on a self-lender program, an online self-lender program. They were charging like 15 or 16% for the loan. That doesn't make a lot of sense. And many credit unions, including Cooperative Federal, offer a credit builder product that you can get at much lower interest rates. So look for that. So these are just some other things to add. Regular credit cards. The only reason why we say use regularly is you want to at least use it enough so that they don't close the account, because it does you no good to build 6 months of history only to have the account closed due to inactivity. Keep it paid off. There's nothing necessarily wrong with store credit cards. It's just that store credit cards can only be used at specific stores. Therefore, you might not use it enough for it to keep active, and it'll close. Better to get a credit card at an institution that you can use anywhere. And then you can do small dollar loans with payments you can afford. Again, it doesn't matter how much you borrow, just that you borrow something and pay it on time, or with a credit card that you have the credit card and keep it paid off. I guess I can't stress enough that it doesn't have to be large sums of money that you're borrowing and paying back. You can do a $120 loan with $10 a month payments. And as long as you consistently pay those payments on time over a year, right? That's fine. That's good for your credit. All right, if you have negative credit, first and foremost is fix, pay past due loans. So get your past due loans current. If you have accounts that are old, that are still open but are past due, catch them up. If you're behind by a month, that means, and you're only paying 1 month, that means you're 30 days delinquent every month, which is terrible for your score. So catch those up first. Then pay down credit card balances that are high, above 50% or really above 30%. And then if you have debts that you are struggling to pay, you can look at refinancing them. Just be aware that, if you're going to be doing a refinance, you want to try to do that at least 6 months out from buying, from pre-qualifying for a home. So you can because when you refinance, you pay off an old loan, start a new loan. So there's going to be an inquiry, and you're going to want to show good payment history on that new loan. Okay. I said it before, I'll say it again. Connect with the counselors at FEC. They're going to be able to help you design a plan that's specific to your needs. So I liken it to like the difference between you trying to figure out how to, build an exercise regimen on your own versus, having a fitness coach, right? Like, the fitness coach is going to know all these things that you don't know, and they're going to be able to tailor a plan to your need, to meet your specific needs based on, based on whatever criteria they base it on, because I know nothing about that. And same with counselors. We're going to look at what your situation is now. We're going to build a plan. We're going to work through it together, and we're going to be there to support you along that way. So, and then the debt management plans. Debt management plans can be great. Debt management plans are plans through credit counseling agencies. We have a sister agency in Rochester FEC, the Financial Empowerment Center in FEC, which comes out of Rochester Consumer Credit Counseling, and they offer debt management plans, and they can be very useful for somebody who has a ton of credit card debt, right? That's really what they're for. A lot of credit card debt, they actually reach out to your creditors. They negotiate lower interest rates on those accounts, and then you make one payment a month to them. They charge you a fee. It's not, it's usually like $50 a month. You make one payment a month to them. They distribute that payment amongst the creditors until those debts are paid off, and they work with you in counseling. It's not always bad. It can be a very good thing. But make sure that you're working with a not-for-profit consumer credit counseling agency, and make sure that that's what you need, right? If you don't have a lot of credit card debt, if you have mostly collections accounts, then debt settlement and negotiations are probably a better bet than trying to do a debt management plan. In fact, I don't think they would bring collections accounts into a debt management plan anyway. So, and we do referrals. So like, if you see an FEC counselor, if you see one of us, we are aware of those programs that are out there that are legitimate, and we'll say, hey, look, you look like a great candidate for this program. Let me connect you with this resource. And you can feel, confident that it's going to be safe at that point, because we're not going to send you someplace that's going to cause you problems. And then again, FEC, there's us again. We're here to support you in this process. And HUD housing counseling, again, both home headquarters and Cooperative Federal have housing counselors, a HUD housing counseling program, homeownership course. So, connect with us to do the housing counseling piece as well. It's really nice having home headquarters as a partner, because, what we're able to do is connect all of these things together, right? So you can do your FEC counseling to get you started. As you go through that FEC counseling, an FEC counselor can be like, hey, it looks like, you're getting really close to being ready. Let's get you connected with a housing counselor so they can create a specific action plan for that goal, which is tricky goal in and of itself, right? All by itself. And it's just really a nice continuum of care and support for financial management matters. All right, we made it to questions. So let's see what we've got. Elise, you want to open up and talk to us? What have we missed while we've been talking?
So nothing in the chat, but there are 2 questions from Q&A. The first question is, this person is thinking of opening a high yield savings account. Would it shorten their credit life because it's a new inquiry? And are there cons to opening one?
You want to answer that, Cass?
Sure. I consider it an achievement when I get to the point where I say open a savings account. So opening an account with a high yield savings agency will not lower your average credit history because you're not applying for debt. So you're just applying for something that's going to give you higher interest. So that sounds like a great idea, as long as there's no hidden fees. Sometimes they have, like if you have your balance under a certain amount, they might charge you a monthly fee. But if there's no monthly fee, that's the best case scenario. That's a great tool for people who have long-term savings goals, because you're going to get more from that savings account than a typical bank account. I don't know if you had anything to add to that, Tom.
Nope.
But congratulations to whoever that is.
Yep.
Not good to pay off car notes early. And the answer is it depends on what your goals are. So in general, I would say, yeah, go for it. If you feel comfortable in your finances, depending on your strategy, I might say have an emergency fund first, because you don't want to throw all your money toward the creditor and then have something come up. But all else equal, sure, pay off the car note so that you don't have that monthly payment anymore. You're saving on interest. Those are all really positive things. But we're talking about from the lens of building up your credit score, and specifically for home ownership, it's good to not have any major changes in the months leading up to applying for the mortgage. So just for that point, just for the credit building side, it's good to leave it open. If you're pretty comfortable, your credit score is fine, I would say go ahead and pay it off if you can to save the interest.
It might, it's funny because on the one hand, paying off a loan early is not going to build your score as well as continuing consistent monthly payments over a long period of time. But on the other hand, when you're going to buy a home, reducing the amount you have outgoing each month towards debt payments is another factor in helping you get a home loan. So it might be a really beneficial thing depending. So again, everyone's unique. The situations are unique, so you really have to think. Having a counselor talk through is helpful.
For sure. If debt to income ratio is the issue, then paying it off would be beneficial.
Yeah. It's tricky. It's really tricky. So this is our next upcoming pop-up is on. Oh, sorry. Actually, no. Sorry. This is not the next one. This is the next one. We're going to talk about grants and assistance programs for your home. And that's on the 6th at 6 p.m. And then we're going to have one on the 11th, which is just frequently asked questions. That's during the day at 12:30. We will have a raffle. So the winner of a raffle, everybody who's here will be entered into the raffle. The winner will get an email. If you want to sign up for more pop-ups, go to coopfed.org/workshops. If you want to sign up for a one-on-one housing counseling session, go to coopfed.org home base, or you can send me an email. If you want any of this stuff, you can send me an email. So if you don't get the presentation now, or you're missing it or whatever, just shoot me an email. I'm happy to figure that out for you.
Did you I'm sorry, I missed the last part of the previous question, but did you answer the question about the 10 payments in the Q&A?
No, I didn't. Kaz,
okay.
You want that question? It's from Karen Schroeder at Home Headquarters.
Less than 10 payments, it won't count toward DTI. I should say the whole question. Is it true that if you have fewer than 10 payments left?
Oh, it's Jenna.
It is Jenna. I knew it was Jenna.
It won't count toward your DTI. That's a really good thing to keep in mind. My understanding is, yes, that's true. If you're pretty close, if you're within 10 months of having a debt paid off, it actually won't be counted in your debt to income ratio. The idea being for most of the life of your mortgage, you're not going to have that debt any longer. Is that your understanding as well, Tom?
That was perfect. And that was a ringer question, by the way. Jenna definitely knows the answer to that question. It looks like Clark has his hand raised.
Yes. 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 Hello?
Hi. Oh, sorry. Yeah. Yes, please.
Okay. So my question is that even when I do my credit report, I'm checking my credit to make sure the credit is going up, my scores is going up. I see that there's certain things on my credit report. There's more like medical, or it's not like loans or credit cards. It's more medical than anything, which is like outstanding because I'm able to get the loans. I'm just not, I don't know if they actually run your credit every time they go about checking to see what your credit score is. Is that a good thing or a bad thing?
So medical debt does hurt your credit, but it's not seen as bad as other types of debt, because medical debt often, I mean, nobody chooses to go into medical debt, right? Things happen and you end up owing money for medical stuff that you couldn't afford to pay for. So it does hurt your score because it is a collections account, and you do want to try to address it. But definitely, like when you're working when you're applying for a mortgage, you want to, you would want to talk to the lender and explain and have them look at your credit report and, talk to them about how that happened, how the debt happened from medical issues. And often it can be overlooked, but the problem is it's still going to affect your score.
Okay.
The lender's going to determine the interest rate based on your score. Even if they approve you, they say, okay, we understand it's medical, we're going to approve you, but your score is low, so your rate's going to be higher. So it's best to try to get rid of it if you can.
Okay, so basically just kind of continue paying on the medical. So that will probably help increase it a little more if I'm making small payments to the medical?
Okay, so that's a great question. So let me back up. The best thing to do with medical debt is to avoid it being on the credit report, and that means making arrangements for small payments with the healthcare provider before it goes to collections, so that you can make payments on time to them, and then it'll never show up on your credit report and it won't affect your score. If it's in collections and it's already on your report, it's best to come to a settlement arrangement where the collections agency to try to get that paid and off the credit report. Making small payments towards those collections is not really good. It's not going to boost your score, because making payments towards collections, all it does is reduce the balance. You don't get credit for on-time payments. It's not beneficial. So the other thing to do, and this is something you can definitely work with a counselor on, is to look at, okay, what's the origin of this debt? Is this debt legitimate? Should this have been covered by my health insurance? Was I covered by Medicaid at the time of this, when this debt happened? Is there a way that I can get it out of collections and make payments to the original creditor? So basically say to Kraus or whatever hospital it is, say, look, I know you're with collections. What I'd really like to do is take this out of collections and start making payments to you so that it's off my credit. So that's what I would say is better than making small payments monthly to them, unfortunately.
Okay. All right. Thank you.
You're welcome. All right. So looks like there's no.
Yep.
Go ahead.
No, I was just gonna say that looks like all of the questions.
Okay. Feel free to throw more questions at us, via email. And we appreciate you coming to this event. We look forward to seeing you on the 6th. And we look forward to connecting with you outside of this virtual world. Hopefully, maybe actually seeing people in person one day.